What's up, guys? I hope you're having a great day. In today's video, I'm going to be going over 4 dividend stocks that I'm buying for increased passive income. Right now, as you guys can see, my portfolio is at $48,766.33. And with that being said, let's get right into the video. This first stock we're going to be looking at is Abbott Laboratories, and they sell nutritional, pharmaceutical, diagnostic, and medical devices. But let's see how they describe themselves. So here at Abbott, we create breakthrough products in diagnostics, medical devices, nutrition, and branded generic pharmaceuticals that help you, your family, and your community lead healthier lives full of unlimited possibilities. And one of the reasons I wanted to pick up Abbott stock is because they are a healthcare company, but they're not like your other healthcare companies that are doing a lot of research and development, trying to find the next best pill or medicine. And so I see Abbott as more of, instead of digging for gold, they're selling the shovels, which is what I like about this company. So let's go over and look at some of their products. You can see they have some child care products like Similac, which is baby formula, which is really hard to find right now. Pediasure, Pedialyte. Here's some of their nutritional stuff like Ellie Care, Zone Perfect, and Sure. Then they have more of their diabetes products like Freestyle and Glucerna. And just real quick story on Freestyle. My wife, when she was pregnant, she had gestational diabetes, and we had to use Freestyle. And the crazy thing about Freestyle, if you buy a pack of 100 of these little tabs, it is $99, almost $100. And you have to use 4 tabs a day. So that means you're spending $100 every 25 days. Thankfully, we had a prescription, so it was only like $13, almost $14. But now let's get into Abbott Laboratories on Seeking Alpha. Currently have a price of $109.79. Year to date, they're down 21%, which means they could be a good buy right now to scoop up on. Their PE is 21.11, which is a little bit high, but not by too much. And then we have a market cap of 191.43 billion. So first off, I want to look at their financials. As you can see on the top line, their revenue is growing throughout the years. That's great to see. Next up, we have their net income, which is also increasing over the years. Then next, I like to look at their balance sheet. Just look at their cash and equivalents right here. That is also growing. Looks like they ended at 9.59 billion. And then I also like to come right down here to their total debt, just 16, almost 16.6 billion. And then their net debt is 6.6 billion, which means they could pay off almost $10 billion of their debt if they needed to. So finally, what we're here for, the dividends. So they do have a low yield at 1.86%. However, their payout ratio is also very low, under 34%, which means they have room to grow their dividend. So sometimes it's all right to sacrifice that yield if you're getting a great payout ratio and a great 5-year growth rate, which is currently sitting at 12.14%. And it looks like they've been growing their dividend for 9 years. So next up, our next stop is Dollar General, which I would just describe them as the cheapest retailer around. And if you guys don't remember, Dollar General, they increased their prices 25% from $1 to $1.25. And as you can see, they just have the regular, it's like a cheaper Walmart. They just have your cleaning, personal care, food, household, and beauty products. So looking at Dollar General, they have a current price of $246.25. Year to date, they're actually up 4.57%. And I'm sure you'll see why once we check up on their financials. So they do have a PE a little high at 22.36. And then they have a market cap of 55 billion. So let's look at their financials. As you can see, their top line revenue has been growing very steadily over time, and that is great growth. And then if we go to their bottom line, their net income, that's also been growing over time. Now it did dip a little bit right here because I imagine during the pandemic, during 2021, people were spending money like crazy. However, it hasn't dipped by a lot. So that's still healthy to me. And then I want to check out their balance sheet. Now, if you look at their cash and cash equivalents, it is slowly rising and it shot up during 2021 at the height of the pandemic. And then it's gone back down to normal levels. But even with those normal levels, we're seeing an increase. And then if we scroll down here, their total debt 16.4 billion, their net debt 16 billion. So even with their cash and cash equivalents, they're not going to be able to pay off a lot of their debt. However, that's fine with this business because they are a retailer. They're going to have a lot of debt. So next, let's look at their dividends and see that they have a really low yield at 0.89%. However, once again, they have a fantastic payout ratio of 20.12% and a 5-year growth rate of 16.17%. And it looks like they've been growing their dividend for 5 years. So this year, I'm looking at dividend growth rate. I'm not really looking at that dividend yield. Even though I'd like it to be higher, that growth rate is amazing. So next up, guys, we have another healthcare company, Medtronic, and they sell medical technology. They develop, manufacture, and distribute device-based medical therapies and services. So just here, their history real quick. They're a leading healthcare technology innovation since 1949. For more than 70 years, we have led the way with purpose-driven healthcare technology. That history compels us to relentlessly pursue therapies that change lives. And then I'm going to go through their products, which they have advanced surgical technology, cardiac rhythm, and cardiovascular products. They have diabetes, digestive, ear, nose, and throat, general surgery, gynecological, neurological, and so on. They have a ton of products. So let's check out Medtronic stock. Current price is $77.72. Year to date, they're down almost 27%. So this could be a good time to buy because they're undervalued. And looking at their PE ratio, it's 14.75, which I would say is pretty low, which means, like I said, they could be undervalued. And they have a market cap of 103.38 billion. Now let's look at their financials. So if we look at their revenue, it sort of goes up and down like a seesaw. However, over the years, the ups and the downs are also increasing. So for now, I don't see that as a threat. Then if we look at their income, sort of the same story. It goes up and down, up and down, up and down, but generally it's trending upwards. Now, if we go to their balance sheet, they have cash and cash equivalents that are also going up and down. However, they have finished with 4.8 billion, which is solid. Then if we go to their total debt, it's 26.6 billion. However, their net debt is 15.16 billion. So even looking at their revenue, their net income, at the end of the day, they can pay over 11 billion of their debt, and I see that as a positive. So last, let's look at their dividends. They actually have a high yield, 3.5%, and they have a solid payout ratio. It's under 50% at 49.25%. They have a solid growth rate of 8.09% and 9 years growing their dividend. So once again, this is another great dividend growth stock. And last up on the list, we have Lowe's, which is a retail investor favorite. And Lowe's is basically a home improvement retailer. So who they are, they grew from one small town hardware store in North Carolina to one of the largest home improvement retailers in the world. So then and now, it says they're committed to helping homeowners, renters, and pros improve their homes and businesses. Now let's look at Lowe's stock on Seeking Alpha. Current price at $199.24. This is another stock that saw a large decline of 22% for the year, which means that could be a good steal to pick up. Their PE is 14.44, and they have a market cap of 120.48 billion. Now let's check out their financials. As you can see, their revenue has grown over the years. Very solid revenue growth. You love to see that. And then net income has also increased over the years. And now it does look like it's dipped so far from the highs, but it's still at a good pace and it's still trending upwards. Now, if we go to their balance sheet, their cash and cash equivalents, sort of similar to Dollar General, it was trending up, saw a huge spike in 2021, and then it's come down. However, on their last report, they're at 3.19 billion. So it's actually increased by quite a bit. And then if we look at their total debt, they're at 38.3 billion. Their net debt is 34.35 billion. So it's another similar story to Dollar General, the other retailer in this list. They can't pay off a lot of their debt. However, we are seeing that steady revenue and net income increase. So that's not a problem to me. Next, we're going to look at their dividends. They do have a decent yield at 2.11%, a fantastic payout ratio, just under 28%. Then they actually have the highest 5-year growth rate at 19.47%, and they've been growing their dividend for 59 years. So guys, I'm really happy to finally be buying Lowe's stocks. I want to say they increased their dividend by 31% in 2022, and I think they did 30%, or it was some ridiculous increase in 2021. So I missed the boat on this stock, but I'm hoping over the years they continue this fantastic growth rate. And with that being said, guys, don't forget to like this video, subscribe if you want to see more investing content,